All right, thank you, Debbie. Thanks for having me back here. Sorry you guys have to get stuck with me twice. But my presentation for today, I do want to start off by letting you know that we have tried to hit many of the high points of things that will impact counties while also being cognizant of timing here. So I do want to make sure that you are aware that we are currently in the process of preparing and releasing our legislative memos. When we do have those come out on our DLGF listserv. So if for some reason you have not been receiving those, let us know. We can make sure that you're on our listserv. Also, as we release each memo, it does go up onto our memos and presentations page. So with that, actually, do I have a, didn't even think about that. Okay, great, thanks. All right, so with that, let's go ahead and jump on in. So the first thing I wanted to touch base on are PSAPs, Public Safety Access Points. HEA 1475 did provide some new language on this that does allow a county who has contractually assumed from another taxing unit those responsibilities. It would allow the county to see an increase in their maximum levy for the increased services that you are providing. The goal here would be that the fiscal bodies of both of the parties or all of the parties participating in that contract would petition the department, and through that process we would increase the county's maximum levy while decreasing the maximum levy of the participating units. We will be issuing more guidance on that. That is one memo we are still working on, but that is something to be aware of. If you are currently the PSAP provider or moving towards being the PSAP provider within your county, that is something you may want to consider. Also with PSAPs, we did have a change to the local option income statutes. And this is really, again, still in 1475, and there's a number of changes that impact local option income taxes. But you may now adopt a public safety LOIT. If you do not currently have one, you may adopt one and specifically dedicate up to 100% of that revenue from the new public safety LOIT to go to help fund your PSAP. Otherwise, if you do currently have a public safety LOIT, but you are not at the maximum rate, you may also increase your public safety LOIT rate while dedicating up to 100% of that increased revenue to your PSAP. So if you already have public safety LOIT and it's already maxed out, this doesn't necessarily provide a lot of options for you. But if you have not yet adopted public safety LOIT or you're not at your maximum rate, this may provide you with some opportunities. I will mention this, we'll pass through it in another slide, but one thing that 1475 also did was to uncouple the public safety LOIT from the other special LOIT types that we've had, which would be LOIT for levy freeze and LOIT for property tax relief, excuse me. Previously, you had to adopt either a levy freeze or a property tax relief in order to also have a public safety LOIT. 1475 did do away with that connection under our current LOIT statutes. I say our current LOIT statutes because we've got a lot of fun coming to us as it pertains to local option income taxes. 1485 has gone ahead and actually combined the three separate local option income taxes that currently exist. So currently in statute we have the county adjusted gross income tax, or CAGIT, we have the county option income tax, or COIT, and then the county economic development income tax. So under 1485, we will be taking those three different parts of local option income taxes and actually making it just one one local income tax for the purposes of administration. In order to do this, there are a number of things that have to occur. The first thing that has to occur is that OMB and any applicable state agencies must prepare a report by November 1st of 2015 that shows how this transition will work. One of the things in that report that we have to document would be all of the current terms and conditions and obligations associated with the existing income taxes. While we have a lot of that information already, because you all provide your local option income tax resolutions or ordinances to us, you may see that we are coming back to you for some additional information. We actually have a planning meeting that we're going to have the first week of June between DLGF, Department of Revenue, and the state budget agency, as well as AOS, to kind of figure out how all of this will work and what our plan is for moving forward with preparing this report. One of the goals of this report is to ensure that under 1485 we have not unintentionally impacted the distributions that are actually going to the taxing units, and also not unintentionally impacted the taxpayers in a negative way. The goal of 1485 is largely simplification from an administrative standpoint. So one of the things you will see would be a new standard ordinance for all counties to use, and most likely that will go up through our gateway process or gateway system. We will be providing new guidance on what your hearings have to be like, what your notices have to be like. And then at a state level, the way that we have modified local option income taxes will allow us to streamline the state administration of this process. So we may be coming back to you to ask some more questions. If this report that we prepare does indicate that we have accidentally done something, then we do have another session of the General Assembly to go back and make modifications. So that's part of the reason why we will be focusing very hard on this report and making sure that we are doing this correctly and documenting everything well. Just to give you a little bit of a brief preview to what we will be experiencing with local option income taxes. This is a table that I absolutely stole from LSA in their fiscal impact statement of 1485. But basically what you will see is that we are taking all of the different pieces of LOIT that currently exist, and they will end up being categorized into three main components: expenditure, property tax relief, and then special purpose. So as part of our report, we will be taking all of the rates that currently exist and modifying those to show you where they will fall into each of these new buckets. Again, we have a transition period. It actually will not be implemented until 2017. So the reports that we will release for local option income taxes later this summer and fall, those will still be under the old system. And then when we do those same reports in 2016, telling you what your distributions are, that will be under the new system. All right, I actually mentioned this already. Now, I did mention it under the standpoint of the PSAPs, but again, just to point out that we have uncoupled the need to have your levy freeze or your property tax relief rate in addition to your public safety rate. 1388, this was actually the department's agency bill. And one of the things that, as we worked through this past budget session, we encountered was that we were having some difficulties with some new language from the session before this one that we just completed. And basically the new language was as it pertained to your operating balance in your debt service funds. And we encountered three main questions during our budget review process. The first question was, is my operating balance in a debt service fund calculated on a fund overall, or is it calculated by individual debts? The second question was that the statute provided for a percentage restriction on the amount of operating balance that you could have, but it referenced the ensuing year. There was a lot of question as to what is the ensuing year. And then the last issue we had was that there were times that the department actually restricted people below what seemed in statute to be the maximum amount allowable. That was largely driven because we treat debt as a need-driven fund. So if you don't need the maximum amount, we are only going to give you what you need. So what we have done in 1388 is to try to go back and clarify those questions. So the first point of clarification is that the statute was changed to say that the operating balance of your debt service fund is the sum of the maximum operating balance allowed by each individual debt. So we will compute your operating balance on an individual debt basis. This is actually what we have been doing all along, but with some of the newer restrictions, we had some questions on how that worked out. Then we have some other restrictions in place in terms of the amount that you would be allowed in your operating balance. If you have a debt that has been incurred since June 30th, 2014, then the amount that you will be allowed for your operating balance for that debt would be the lesser of either 15% of the budget estimate for the year after the budget year, or the first payment to be made in the first 6 months of the year after the budget year. And I've got an example in 2 slides that will make that a little more clear. But if you have a debt that was actually issued before June 30th of 2014, it's a similar type of restriction, except in that case you would be allowed the lesser of 50% of the budget estimate for the year after the budget year, or the debt payment to be made in the first 6 months of the year after the budget year. So just as an example, I have prepared here where we have a debt that was issued prior to June 30th of 2014. So when we are looking to see what we would allow for an operating balance for that debt, we will first look to see, for the 2016 budgets, we will check to see what your total debt payments would be on that debt in 2017. That would be the year after the budget year. So in this case, in this example, the total debt payments in the year after the budget year is $1 million. However, the payment due in the first half of 2017 is only $400,000. So as we look at this and try to determine what the operating balance would be for this debt, we are going to first say, okay, what's 50% of your total debt payments in the year after the budget year? So in this case, 50% of $1 million would be $500,000. We'd compare that up to the first half payment, which is only $400,000, and so we would provide only $400,000 for that operating balance. So I will say, as I've had the opportunity now a couple times to talk about this is much harder to speak about than I think it is to see in words. So we are currently working on our legislative memo for this particular provision, and it is my intent that we will include a number of different examples so you can see how this plays out with different types of debts. Continuing with debt, we do have some changes as it pertains to controlled projects. Controlled projects would be those projects that meet the threshold requirements for either a petition remonstrance or for a referendum. So under SCA 251, they have now added in the opportunity for a person that either owns property or is registered to vote within a political subdivision to file a petition with the department if they feel that a project is being inappropriately divided for the purposes of avoiding either petition remonstrance or referendum. This is an issue that we encounter every year. We always get some phone calls from taxpayers, and unfortunately prior to this there was not an official process in place. We do now have a petition process in place. Taxpayer who is interested in doing that has up to 10 days after the preliminary determination to either issue those bonds or enter into the lease in order to petition the department. Once we receive that petition, the department has no more than 30 days to review that petition and provide guidance on that petition and indicate whether or not we also believe that the project is being artificially divided. In order to assist both the taxpayers and taxing units with this new approach, we are in the process of preparing some guidance for everyone in terms of how we consider controlled projects. What do we consider a project? And then we also have prepared a sample petition that we will make available to taxpayers. Certainly there are way too many situations that we will encounter on this to be all-encompassing in this guidance, but our goal with the guidance is to at least point everybody in the same direction so that both a taxing unit and a taxpayer knows initially where our mind is at when we start to consider whether or not a project has been artificially divided. So I hope that that will also be helpful for you all as well as you are looking to issue any controlled projects. We have a number of changes as they pertain to redevelopment. The majority of these changes will actually impact starting in 2016. So it does not necessarily impact your reporting requirements or anything for this year, but you will see these changes coming. So first, under 567, first they have changed the date of the Redevelopment Commission Treasurer's Report. It used to be before July 1st. It is now before April 1st. If your county has a redevelopment commission, as county auditor, you would be serving as your redevelopment commission treasurer. So this is something to be aware of, that you have this reporting requirement that you currently have, but it will be moving up a couple of months. They also have modified when the treasurer of the redevelopment commission may disperse funds. So the general statement will be that the treasurer may only disperse funds once after the commission has approved that disbursement. However, the Redevelopment Commission does have the ability to authorize the treasurer either by rule or resolution to make certain types of disbursements before the commission's approval at the next meeting. So that may be something that you want to work with your Redevelopment Commission on to determine, are there certain disbursements that, because they need to be done in a timely manner or something along those lines, that it would make sense for that rule or resolution to be adopted to allow you to proceed with those disbursements prior to the commission's next meeting. We also have seen a change on the reporting requirements for redevelopment commissions. Essentially, what we have done is to take all of the different redevelopment reports that have come along over the last several years, and we have consolidated them into one report. I'm sure you all can read this in great detail, and I really didn't put this in here so that you did read it in detail. Just more wanted to show you that we currently are in a situation where there are 3 main time frames for reporting from the Redevelopment Commission to either the unit's fiscal body or the unit's executive and the department. So currently we have a March 15th report, we have an August 1st report, and then that August 1st report has to actually be filed with the department by October 1st. Many of the pieces of information that are being collected in these reports overlap. We're looking at prior year revenues, prior year expenditures, fund balances. So rather than having this information being reported multiple times to multiple people in multiple ways, what we have done is gone ahead and actually consolidated all of those into one report that will be due by April 15th each year. It does have to be filed electronically on Gateway, and so as we move closer to the start of 2016, we will certainly be providing more information and user guides about how to utilize that new consolidated report. Continuing with redevelopment, we do have a date change starting next year in when the Redevelopment Commission needs to notify county auditors of any excess AV to be released. Currently, it is commonly referred to as the July 15th letter, that before July 15th, the Redevelopment Commission needs to tell you whether or not they have AV to be released, or TIF pass-through is also a term that we will use for this assessed value. Starting next year, that timing will move to July 1st. Also, the department must be electronically notified of those letters, of that notice. So again, we will be taking that up to our gateway system to collect that information. I believe we still have to sort out our policies, but it would be my intent that it would still be the requirement of the Redevelopment Commission to actually post that up on Gateway to us. For redevelopment and starting to get into assessment issues, in 436, there was a change that is effective yet this year in July 1st. A taxpayer may actually enter into a written agreement with an entity that is able to establish an allocation area. So that could be a redevelopment commission, it could be a redevelopment authority, a military base reuse authority. There's a number of different types of entities that can establish TIF districts. In that written agreement, the taxpayer would essentially waive their right to review of assessments during a given time period. So typically that given time period is going to be the term of a specific bond or a lease that may be payable from the property taxes within that TIF district. So by entering into this written agreement, that taxpayer waives their right to a PETA-BOA review, an IBTR review, Board of Tax review, as well as a tax court review. So that could be something that you will start to see with your redevelopment commissions, that as they are looking to do projects for a particular taxpayer or a particular economic development project, they may be looking to get this type of written agreement from the individuals that would be assisted by those projects. All right, I wanted to go into some of the assessment changes. We had a number of assessment changes. So the first is on personal property. Last year, or under the 2014 General Assembly session, counties were provided with an option to exempt personal property less than $20,000. This year, they have actually modified that to make that automatic. So effective July 1st of 2015, so really starting with the January 1, 2016 assessment date, if the acquisition cost of a taxpayer's total business personal property within a county is less than $20,000, then that taxpayer is exempt from paying property taxes on that business personal property. The taxpayer does not have to file the traditional business personal property forms in order to claim this exemption, but they do have to provide an annual notarized certification indicating that they are exempt from taxes on that property. Another assessment change, this was something that David had mentioned in his presentation as well. Typically we're referring to it as either big box stores or dark stores, you may have heard it called. There has been a change in the way that big box retail facilities are being assessed. It specifically applies to those that are at least 50,000 square feet and are still occupied by the original owner or tenant. In that case, for any improvements with an effective age of 10 years or less, statute now requires that they are assessed using the department's cost schedules. When you do assessments, you have the opportunity to do primarily 3 different types of assessments. You can either use a cost approach, a sales approach, or an income approach. In this case, statute will now require that these improvements, 10 years or less in age, will have to use the cost approach. Statute does indicate that the land value would need to be assessed separately from the improvements. And if a taxpayer chooses to request a review of their improvements that have fallen under this restriction, the taxpayer must provide actual construction costs for those improvements. If for some reason the taxpayer has initiated that review and it ends up that the actual construction costs are higher than what the cost schedules actually calculated, then moving forward their assessment would be based on their actual construction costs less any depreciation or obsolescence. So certainly it's worthwhile for taxpayers to be very cognizant of what their assessment is based on the cost schedules versus what their actual construction cost was. For assessments, we also had a change in the agricultural land base rate. For several years now, due to the formula that is being used to calculate the ag land base rate, the base rate has been increasing, so many counties have seen their AVs increasing largely because of, or at least partially because of the ag land base rate change. So statute has come out to say for the March 1st, 2015 assessment date, they actually are going to hold that AV at 2050, which is the same base rate that we had last year. So while it was originally projected to jump to 2420 for this assessment year, all of the assessors are now going back and dropping it back down to the 2050. Moving forward, rather than using the formula that we have been using for the last several years, the base rate will be increasing based on the assessed value growth quotient that is used each year to modify property tax levies. All right, on appeals, 1603 had a number of changes as they pertain to appeals. The first big one is that the fiscal officer of a taxing unit may now establish a property tax assessment appeals fund. What is supposed to go into this fund would be any property tax receipts that are attributable to an increase in the taxing unit's tax rate caused by the assessed value withholding that you all do during your certification of net assessed values process. So you may identify that, hey, we think we may have some appeals coming through. You may withhold up to your 2% automatically, or you may petition the department to actually even withhold more than that. If for some reason those appeals don't come through the way that they anticipated, so the actual AV that is being taxed is higher than what that net assessed value is, the taxes on that increase are able to be put into this property tax assessment appeals fund. Money in that fund may only be used to pay for any expenses incurred by the county assessor in defending appeals, specifically in respect to property located within a particular taxing district. So for counties, you all have all the taxing districts, or for refunds due to appeals. The balance in the Property Tax Assessment Appeals Fund may not exceed 5% of the amount budgeted by the taxing unit in any given year. And this last bullet point here is something where the department is still working on trying to sort out exactly what this means for us. Statute says that the money in this fund may not be considered a miscellaneous revenue for the purposes of the department's budget review. So we are working through how this new fund will play with the rest of our budget review process, and certainly we will issue new guidance as needed. This fund itself is not effective until January 1st of 2016. So as we go through our budget review process, I want to make sure that from a statutory standpoint, we have everything in line to work with our budget process correctly. So you may see the department going back next year just to get some clarification on exactly how this should play out. Also with appeals, the county assessor now on a quarterly basis must send a notice to the fiscal officer of each taxing unit affected by an appeal. That notice may be provided in electronic format, so you should start to receive these notices. The notice must include the date on which the notice was filed, the name and address of the taxpayer, the AV for the assessment date prior to the appeal, and the AV of the most recent assessment date, and then the status of the appeal. So this should assist you in tracking a little bit better where your appeals are at. I mean, certainly at a county level, I know you all talk with your county assessors all the time, so I think that this is much more for the benefit of, say, cities and towns or other taxing units where they may not have the opportunity to just walk down the hallway and talk to somebody about what's going on with appeals. But you also will be able to benefit from that. Next, we have refunds. This was effective upon passage, so this is currently effective. So for any refunds that are due based on assessments for the 2014 assessment year or prior, as county auditor, you may now elect to provide credits in equal installments over the course of 5 years, rather than actually issuing a refund to that taxpayer. So they do have to be equal installments on your future property tax installments. And then you may also, if you start down this process, statute does allow you to accelerate those credits within that 5-year period if you would like to move forward in order to actually just provide either the full or the partial refund. All right, annexation. I'm only going to touch on something very, very specific for counties from 330. 330 does have a number of other changes that impact annexation, but for my purposes today, what I wanted to highlight was something as it pertains to agricultural land. So for annexations adopted after June 30th of 2015, agricultural land is exempt from the municipal taxes that would be typically assessed to them while this is agricultural land, while that land is still agricultural land. What this means, the reason why I wanted to highlight this, is that you all may want to carefully consider how you are tracking this within your taxing districts. We have had a number of these instances occurring in recent years, and what we have found works best is that when you set up that new taxing district, or when you set this annexation up, you will want to put this agricultural land into a new separate taxing district. We would also advise you to clearly mark that taxing district as municipal tax exempt, MTE. We see that abbreviation a lot on taxing districts. The reason for doing that is that it very easily identifies to the department that we should not put city taxes on that particular taxing district. So certainly I would also encourage you to work with your budget field rep and make sure they understand how you have tracked these annexations. Through the taxing districts, naming and numbering your taxing districts, there's a very easy opportunity there to provide us with that flag so we know how to track it. All right, just a couple more smaller things. Tax rate chart. Historically, the county treasurer has had the statutory responsibility for actually publishing the tax rate chart once you have your tax duplicate completed. Starting next year, that responsibility does change to the county auditor. So I think we actually just issued a memo on that this week. 1603 provided some clarification on deadlines, and it does specifically say that if there is a deadline imposed on a political subdivision, the DLGF, or the Indiana Board of Tax Review that is not on a business day, that deadline then does roll to the next business day. Historically, that's how we have most often treated this for the purposes of the department's deadlines. However, it is now officially in statute that that is how it should be treated. So we actually just released our budget calendar, a revised budget calendar earlier this week. And so you will see on there that there are certain things that we have moved to the next business day because the statutory deadline fell on a weekend. And then lastly, we have a change from 1495. This is just on special meetings, since you all work with your county councils. As it pertains to special meetings, they did change the notice requirement for a special meeting from 6 days to 48 hours. This is in instances where the meeting is not necessarily an emergency meeting, but just simply a special meeting. So that may be something that will impact you moving forward as well. So with that, I will go ahead and stop. I certainly am happy to take any additional questions. I'm going to be around for a while yet today, and Mike as well at our resource center can certainly take any questions as well.